Hello and welcome everyone. Good morning and welcome to the second day of the expo. I welcome everyone out of here. So today it's a really important topic and I believe every single trader must be familiar with. It's about hedging. What does corporate companies and investors do to mitigate their risks? My name is Mohammad Shanti. I'm the head of market research at ATFX. And today we will give you more insights about all the details that you want about hedging. At the end of the session, if you have any questions regarding the strategies that we're going to talk about, feel free to ask whenever you want. So what is hedging? What does hedging mean? Basically, it's a strategy used by corporates or corporations or investors to mitigate their losses whenever they see a possible risk from a change in currency rates. For example, if you have, a lot of euros within your hands, and you're afraid of this kind of currency movement or currency rate movement, and you don't want to lose the amount of money that you have or the value of it, what do? You do hedging. So why do we need Forex hedging? Basically, fluctuation protection. As you know, in the Forex market, the market tends to move a lot. And since there is a lot of economical events and a lot of geopolitical tensions and other factors, they do affect the market fluctuations and they do affect the currency exchange. The second thing, in order to reduce your overall risk, it's important to have a risk strategy, especially when you're handling the Forex market. Third, to manage your cash flows. A lot of corporations, they tend to buy a lot of products in several currencies. And in order to maintain the value of their products, they tend to manage their cash flows depending on the market fluctuations. Fourth, whoever have this advantage of mitigating the risk can actually get a competitive advantage because the company or the investor is able to maintain its profits. So that's why we need the hedging strategies. So what type of hedging strategies corporations tend to use? Usually, they use different products, such as the forward contracts, which is basically lock-in exchange rate for future transactions. Second, the option contracts, which is the buy the right to exchange at a certain price without any obligations. The third one is currency swaps. So swap currency is basically an obligation with another party to reduce the risk. Fourth, which is called natural hedging, the balance currency inflows and outflows to reduce any exposure. Finally, which is more common, netting. Netting is especially used by corporations. They use the currency exposure across different business units. So basically, they handle one unit with a certain currency and another unit with a different currency in order to mitigate the risk. So instead of Hello? Oh, sorry. So basically, instead of putting your risk in one currency for the whole business units, you reduce it or diversify in different currencies. So there are 4 metrics every single corporation needs to focus on. First, which is the total monthly or quarterly or yearly exposure. They need to know exactly how much money inflow coming in order to do forecasting. Once they do this kind of forecasting, they can do something called hedge ratios. By doing the exact amount of hedging strategies or hedging units that I have and compare it to the next, or let's say, forecasted items, forecasted cash flows. Then I need to know exactly the rate required to achieve the budget, but basically calculating the rate needed for the rest of the year to meet any budget that I have based on delivered trades, based on existing hedges, or remaining in the forecast exposure. Finally, the fourth metric, which is profit and loss scenario analysis. Basically analyzing both the profit and potential losses to know if I need a hedging strategy or not. The more profits I make, the lower need of hedging. However, if I'm anticipating a possible loss from currency exchange rates, then I need to think of applying a certain strategy to mitigating the risk. This is from a corporate point of view. Now, how can retail clients such as yourselves use this kind of strategies? What do we do? Now, with the ATFX, as a broker, we provide CFDs, correct? Now, CFDs is basically purchase a contract for difference for a certain asset. So let's assume someone or a trader who's actually trading the euro dollar, trading the pound, trading the yen. However, he's expecting a possible drop down in the purchased item that he had. So what do we do? Basically, we apply either one. If I have a certain amount of euros in hand, all I need to do is do a short selling. So if I'm expecting the price of the euro going down after I purchased it, and I'm afraid of that risk, what do? I just purchase the same amount, do a short selling. Now, let's say if I'm handling the euro, but I want to hedge it in a different way. This is where the correlation with different items is being used. So for example, the franc Swiss is correlated with the euro. So if I believe, let's say, even if I purchase the euro dollar, and I believe that there's a chance that the price will go down, what do? I purchase the dollar franc, or basically selling the franc, because it's basically correlated a lot. So the change in the currency rates can help me mitigate when doing this kind of strategy. Another way of doing the hedging strategy, assume that you have gold, ounces of gold. If you have physical gold within your hands, and you're afraid that the price of gold will go down, what should I do? It's very simple. Using leveraged CFD contracts, such as the gold, you don't need to have the same exact amount. Because of the leverage, I can use a smaller amount to purchase the exact amount of ounces. So basically, if the price goes down, I will be losing in the physical price. However, with the CFD, I will be making money. So basically, they are hedging each other, so basically mitigating each other. This is the concept of hedging. Thank you so much for your time. If you have any questions, feel free to reach me out, or you can ask now. Thank you.